We never wake up saying, I wonder how I can mess up my life today.
Hmm.
Everything that you're in trouble on now, every problem you have started out as a good idea.
You're listening to Investing for Good, a show that brings you the stories and strategies of people who are investing to build a legacy for their families, create a meaningful and intentional life by design, and impact the world around them. And now, here are your hosts, Annie Dickerson and Julie Lamb.
Hey, Julie, how's it going?
I'm doing really good over here. I'm super excited because we just canceled our trip to Hawaii for the summer, but not excited about that, but excited that we were actually able to find a place here about an hour and a half away from our house up in Sacramento to rent for the summer. So we'll be there for 4.5 weeks. And it's like a miniature, like Disneyland farm. And it's like 2.5 acres on a gated lot. There's a huge swimming pool. There's a huge playground with like swings and multiple slides and like a climbing
What?
structure. It's
Oh my
all
gosh.
like huge. We could probably camp there because it's nothing but like grass. They have an adult sized trampoline. They've got a foosball table, ping pong table, like life size Jenga, Connect Four. I mean, it just kind of
What?
like, I
You're
know
not
it
even
goes,
going to be able to find your
I, I
kids.
know,
They're
but it's great because it's gated. So I can just, and there's like
Yes.
concrete so they can ride their
Oh,
bikes and scooters. And
oh my
after the last
gosh.
2 months, or by the time we get
Yeah.
there, it'll be like 3 months, almost 3.5 months of being locked up in our house to be able to like let
Hmm.
them go free. I am just so excited about that because the poor kids, I took them out yesterday to the Great Highway down by my house to just roam free because they closed it off. And the kids literally, their scooter wheels hit the pavement and they just, I mean, I couldn't even call them back fast enough because they just took off because the poor things, they have not had that space to just like roam free.
Hmm.
So anyway, I'm just
Yeah.
super excited about that.
Oh,
Yeah.
I'm so jealous. That sounds amazing.
Yeah.
And it's so, you think like, oh, bummer, Hawaii, but then you find this gem
Yeah.
practically in our backyard. I mean,
I
and you
know.
must have gotten a great deal on it given everything that's
Yeah.
going on.
Yep. Yeah. I think I
Yeah.
booked it like just kind of at the right time. So we're really excited
Ah,
about that. Yeah.
now I'm going to have to go look. Ah,
Yeah.
I'm so jealous.
Yeah.
Ah, well, that brings us to today's conversation, where we talk about so much. Man, we
Oh
might as well have
gosh.
talked about Disneyland.
I know.
I
I
mean,
know.
our conversation today was with Paul Moore. And man, I can't even begin to intro him because he's done so much. He tells us the story of how he got started in real estate almost by accident, sort of
Hmm.
learning about this thing called an auction on the courthouse steps. And
Hmm.
he decided to sort of just go on a whim. And then he fell into flipping homes and realized that that could be profitable and started getting into development deals as well and hotels. And now he does self-storage and mobile home parks. He's also done multifamily,
Hmm.
and he's that guy's everywhere. He's got so much wisdom. He's on Bigger Pockets all the time. He's written books. He's done so much.
Uh-huh.
And man, we, like I said, we cover so much in this conversation.
Yeah, it
What were
was.
some of your gems or your takeaways that
Yeah.
resonated best with
Yeah.
you?
I mean, I think like one thing that really was super interesting to me was his pre-mortem approach, right? To looking at deals and looking at partners. And he said that, in when they do this, they go forward in time and they're acting like they failed and they're asking what could possibly go wrong and kind of like jumping forward in time and looking backwards and making sure that they kind of, do everything that they can to make sure things don't go wrong, which I think is such a different approach I never really thought about. That was one thing. I think another thing was when I asked him the question about what's the number one way how to lose money in real estate, because that's the name of his podcast. And he had said that the number one thing that he thinks, he mentioned a couple others, but the number one thing was a lack of due diligence. And every time I talk with investors, I go back to this again and again because investors always get so caught up in the numbers on this particular deal. You're kind of doing yourself a disservice because you're just looking at like one grain of sand on the whole beach, and there's so many other things that you really need to take into consideration, particularly as it relates to the operators, and really getting to know who they are, and what their track record is, what their background is. And he talked about that a little bit as well, which I love that he brought up is, trusting the gut feeling. He talked about, how are they interacting with the investors? How do they treat you? How do they talk to you? And that's something that we use all of the time in, all of our partnerships and people that we work with and, allow into our space, is really trusting that sense of like, are these people good hearted people, and are these the people who are going to do the right thing? And I feel like that's what has allowed us to have so much success in what we do, is because we use that as our guiding post. And I'm just really glad to hear that he does as well, because he's in a similar field as us in terms of how we structure our deals and our approach to investing.
So much wisdom shared in this episode. To all our listeners, you're going to love this one. Here is our conversation with Paul Moore. Paul, how are you?
I'm doing great. Thanks for having me on the show.
Yeah, we're thrilled to talk to you. You have so much experience and knowledge about real estate, so we're really excited to pick your brain. So now, Paul, you've been involved in so many different aspects of real estate investing, from fix and flips to rental properties, development projects, hotels, multifamily, self-storage, mobile home parks. I could probably spend the whole show just listing out all of the things that you've done.
It's dizzying. It's exhausting.
Well, I know that doesn't just happen overnight, right? Each of those asset classes and investments takes quite a bit of time and energy to learn about and to get into. So take us back to the beginning of this crazy journey. So how did you get into real estate in the first place? And what were you hoping to achieve at that point?
Yeah, so I had sold my company to a publicly traded firm in Detroit in 97 when I was about 33 years old. And I moved to the Blue Ridge Mountains of Virginia, and I started a nonprofit organization. It was sort of an international student outreach. And I found myself at like 35, pretty bored, high energy. And the people that were in this volunteer organization I put together were super laid back, and they wanted to do a few like retreats per year. And I wanted to do like several a month. And so I was looking for something to do. And I had heard a rumor from a neighbor that you could buy houses on the courthouse steps for 50 cents on the dollar. So I thought I'd just mosey down there with no money in my pocket intentionally, just to see what the auction was like. And they rolled a house out that I'd already comped out at $64,000 for like $32,000, and there was nobody else bidding. So I ran to the bank on an icy day in December, and I got a check, cashier's check. I bought the house, flipped it, made a very nice profit on a short time. And I thought I could do one of these a week. Yeah. So after losing money on 2 of the next 4, I realized it was probably harder than I thought. But at any rate, I just kept, I think that I mixed up investing and entrepreneurship in the early years. I could say more about that later, but I can tell you that as an entrepreneur, I was always looking for the new shiny object. And I became a shiny object chaser, which was not super healthy for the bottom line. In fact, I found myself speculating more than investing, and I found myself chasing the new thing. And like you said, it's really hard to go deep when you jump around a lot like that. And just kind of jumping to today, I will tell you that when we got into the asset classes we're currently involved in, we took the opposite approach. We actually decided we were not going to be the operator, but we were going to go out and find the very best in class, most experienced operators we could and invest heavily with them. And that's what we've done as a change of strategy to what I did all those earlier years.
That's really interesting. Sounds like now instead of vetting the assets and looking at markets and maybe going on the ground and doing the inspections and rolling up your sleeves and doing the renovations, you are now spending time fostering and creating those partnerships, which, as we know, the team is so important. So can you talk to us a little bit about that, how you go out and find these partnerships? It must be hard to find the right partners.
It really is. I've been reading Warren Buffett. I'm actually writing a book called Warren Buffett's Rules for Real Estate Investors. And he apparently developed a very long relationship with a guy named Tom Murphy, who he considered the best CEO in America. And when Tom called him in 79 and said, I need better part of $1 billion to acquire ABC, Warren made a decision in 15 minutes because he trusted Tom and because he knew of Tom's track record. And so that's what we do. We spend a lot of time on the phone. We've interviewed 3 operators just this week in 3 days, trying to find the ones who have the right fit. We have about a 25-point list that we want them to hit the vast majority of in due diligence before we'll invest. And then even at that point, our goal is to invest a small amount first, see how it goes over the first quarter or 2 before we really plunge in deeper. So that's how we do it.
So how are you guys actually finding these folks? I mean, are you picking up the phone, trying to find cold calling, trying to find who the operators are, or what is the strategy that you're using to find them?
Yeah, so we get recommendations. For example, I know a self-storage broker in Raleigh, North Carolina, and he knows a lot of the operators, and he knows who's looking for money, who's a better operator than they are a capital raiser. And so he recommends somebody to me, for example. Other people I'll meet through Bigger Pockets. One person, I actually saw their not Crowd Street, but I think it was a Realty Mogul or something like that webinar. And I was so impressed with the webinar, I just picked up the phone and called him the next week. And we struck up a great friendship. And he's been a great operator we've invested with for a few years.
Interesting.
Wow. Tell us about that 25-point list. I'm curious. I mean, you don't have to go into all 25, but what are some of the ones that are maybe harder for people to pass? So what are the parts of the gauntlet that people get stuck on?
Yeah, so we do the death by Google thing where we just Google them everywhere we can with every, criminal, the word criminal, violation, SEC, etc. We do criminal check, background check, reference check, talk to current investors. We try to talk to staff. Well, if we really go down the road with them, we'll drop in on their facilities and see how they're really run compared to what they told us they were. We'll see how they treat their employees, how they talk about their investors, their spouse, how they talk to the waiter or waitress. Basically, we really, really gauging for that moral capability. It's better to be in a good deal with a fantastic operator than a fantastic deal with a mediocre operator. And so we spend a lot of time. And then I believe we were created with about, I think it's 3,000 receptors, if you will. I'm using that word loosely, to where we can pick up body language, tone, all kinds of things. And our brain that does trillions of calculations per second can actually notice things that we don't know. And I think that translates out to what we typically call a gut feeling. And so I used to ignore that. I used to I worked really hard to override my gut feeling, much to my detriment for years. And every time I did, and every time I didn't listen to my wife, I actually lost money. And so don't tell her I said
I was just going to say, we'll share this with her. She'll be happy.
Yeah. So no, I learned to listen to her, and I learned to actually respond to that gut feeling because when I ignored it, I paid dearly.
It's so funny that you say that because, we have our coaching program where we teach folks how to raise capital. And that's something that I talked a lot about in the section of the program about how to vet an operator, how to vet a partner. And it sounds so simple, like that's kind of all there is to it, but there's so much in that. And for me as well, that is in the beginning how I gauge all of the potential partnerships and people that we decide to work with is, I think more of like the bottom half of the things that you just mentioned on your list are, just that how are they talking to investors? How are they talking to you? How are they responding to the inquiries and the questions that you have? And are they responsive, or are they just ignoring most of the questions and answering only a few? Or, those things are so important when you think about somebody that you're going to be in a business partnership with for, a long period of time, 5 to 7 years,
Right.
And so I think that's so great that you bring that up because I think investors often get really lost in the details, right? They get really lost in the numbers, and and they just get so caught up in that. It's like we really need to take a step back away from that, really ask ourselves who are these people that we're working with, and really have a good feel for if this is the right partnership and if this is the right person. Because at the end of the day, if it's not, it's going to be a long road ahead. Even if you're making your annual returns and the projections, if you're not feeling comfortable at night, you're not going to be able to sleep at night. And so I think that's such an important thing for passive investors to think about and keep in mind.
Yeah, I agree. We never wake up saying, I wonder how I can mess up my life today.
Mm-hmm.
Everything that you're in trouble on now, every problem you have started out as a good idea. And I think it's really important. We did a pre-mortem today.
Mm-hmm.
And a pre-mortem is like a post-mortem where you go back in time and say, here's what went wrong. Here were the failure points. Here's who was responsible. A pre-mortem is going forward in time, acting like you failed, and then looking back and say, okay, what were the points of failure? And then you basically say, okay, well, what could go wrong? And then we use that today when we questioned an operator in our approximately 7th call with this operator. We used those questions as we were asking them, what could go wrong from your point of view? So,
have you guys ever lost a deal or lost investor money or had a deal that went sideways? And if so, how did you handle that?
That's a great question. So I was so proud of myself that for years, from 2000 to the last several years, I didn't lose a dime on any real estate investment. I did a whole bunch of smaller deals.
Mm-hmm.
But what happened, an apartment deal we purchased, and I won't say this is gut feel, but this was actually a mentor saying, I don't know, a 1962 apartment might have some problems with, corroded pipes underground and things like that. And we were already under contract by the time he said that. But I think we should have listened a little more, because this was the last asset we acquired. It was a number of years ago, and before we moved to the new model. And it did have lots of problems. It had a $107,000 leak in one building alone, and they had 19 buildings. And we were seeing signs that the other buildings might have similar problems on the horizon. And so we actually sold that for a modest loss. We actually gave investors a choice. We said, look, we can continue to plow on and hopefully fix this and turn it around, or we can take a small loss right now. We've got offers coming in because, the market was so hot. So we went ahead and took that loss. Now, the answer to the way I handled it, I did something that I would not recommend a lot of people do. I think it probably keeps a little bit in line with your podcast theme. But I told the investors, I said, blame me. Don't blame the inspector. Don't blame the property manager. Don't blame the rest of our team. Just blame me. I was the point person with all, 49 investors. I said, here's what I'm going to do. If you want to, and this was really hard. The first time I said it to somebody, I almost cried. But I said, if you want to take another chance, I hate to use that word, but if you want to risk it and invest in this other portfolio of deals I have, this portfolio, I will guarantee you, and you don't do that in investing, but I said, I will personally guarantee you will not only make back what you lost, but you'll make your original projected return of 13% a year over the next decade. If you don't, to the amount you fall short, I will write you a check out of my pocket. And so we had a number of investors take us up on that, and they reinvested. In fact, our largest, I think number 1 and 2 largest investors reinvested. And I don't know how it's going to turn out, because, we're years away from the end of that decade, but that's what we did. That's what I did, at least.
Yeah. Yeah, so, that right there, it's always what you want to know, because the deal could have looked however it would have looked, right? On paper when they first saw the deal. But at the end of the day, it's when things go sideways and things go wrong, and how the operator chooses to handle that situation is what makes it or breaks it. It's not even the deal, because look, at the end of the day, those people still walked away with a great situation, right? Because of the way you chose to handle it. So even though the deal didn't go well, because they had a great operator, they were still made whole, and everything was okay. And so that's why when we talk with investors too, we always talk about, make sure you know who we are, who our partners are, make sure you understand all of this, and make sure that you're comfortable, because at the end of the day, yes, it's important to look at the deal specifics, of course. You need to do your underwriting and your due diligence there, but you absolutely need to know who you're working with.
Right.
Yeah. Yeah. So.
And what year was this?
2017.
2017. Okay. So yeah, the time is, I guess, just started ticking on that decade. So we'll see how that goes. It brings us to an interesting point with everything that's going on now with COVID-19.
I know, right?
I guess it's a good thing that you sold in 2017, even for a modest loss, because, if you had held on, who knows what would have happened at this point. So
actually, I need to correct that. We acquired it in 2017.
Oh, okay.
We actually sold it more recently.
Oh, okay.
Yeah.
Gotcha. Okay.
What market was that in?
Oh, it was Lexington, Kentucky.
Okay.
So my advice to people who ask me now is listen to your mentor. The other piece of advice was, basically the mentor said they never acquire anything pre-1978. That's their cutoff. And, I tell you, you all know this too. It's so tempting in a bull market when we were getting outbid every turn. We were getting, we were seeing $5 million deals go for $7 million. And I don't think those people are going to do well in this next environment here. We can talk about that or not. But, we finally, if we thought if we're going to compromise on one thing, it'll be the year built. And that's what came back to bite us.
Mm-hmm. Yep, that's what we always say too. So in the beginning, in the early days, we did a few C-class deals and, learned our lessons there. And out of the 20 plus properties that we own, I think we have 2 that are C-class. And, you just never know what you're going to find when in those C-class properties when you start to pull back the walls and you start to do the renovations. And it's really, actually now it's funny because all this time before we used to preach no A-class, and now we're actually looking at some, high B plus A class assets that don't have, because all the risk is in the renovations, right? So along with the value add, you take, increases the risk. And so now we're looking at a little bit, more stable properties and trying to really stay away from, the heavy value adds or the repositions that we were doing before.
Have you noticed the more experienced investors get, the more they trend that way?
Yeah, I guess that's true. I don't know. I never really thought about that. Is that
maybe not across the board, but I think so.
Yeah. Yeah.
Well, I think probably as you get more savvy and you've done more of these investments, your capital is growing, and now your risk tolerance is probably also lower, right? Because you don't want to lose that money that you've worked so hard to make.
That's exactly right. Perfectly said.
Yeah. Yeah. So I'm curious to hear your perspective on everything that's happening with COVID-19, and I want to hear from you and understand what your perspective is on the impact of this in the near term and the long term and then the longer term, and understand what you think is going to happen in the real estate space, specifically multifamily. And then you also do self-storage right now, or is it just multifamily? It's both.
Yeah, in 1918. No, in 2018 we looked. In 1918 there was this last pandemic, right? But seriously, in 2018 we started looking outside of multifamily. Even though I'd written a book called The Perfect Investment, very humble title, I actually decided we would look outside that because we found out that 93% of multifamily above 50 units was owned by companies that had typically wrung the value out of them. And so we also found out that about 75% of self-storage is owned by mom and pop operators and small operators who don't know how or don't have the resources or the knowledge or care to get all the value they can. And 90% of the 44,000 mobile home parks in the U.S. are owned by mom and pop single asset owners, and they absolutely leave meat on the bone, profit potential all the time. And so we decide to switch over, broaden our horizons. We still like multifamily, but not overpriced multifamily. And one of the reasons we did that was because for many reasons we probably don't have time to get into, self-storage and mobile home parks are very recession resistant. I can tell you a few. Mobile home parks are the bottom of the housing ladder. And so if you can't afford a mobile home park rent, which is typically a third of an apartment rent, you probably will end up under a bridge. Mobile home parks also have very sticky tenants. Usually when someone spends $5,000 or $8,000 to move a mobile home into the park, they usually never leave. It's the only asset class that has a shrinking supply and an increasing demand every year. 10,000 people a day are turning 65, but 6,000 of them every day don't have more than $10,000 saved for retirement. Amazing. So mobile home parks really work well for a lot of those people who can trade their home equity in for a mobile home park lifestyle and the flexibility that it brings. Self-storage, typically when people are doing the 4Ds, they're moving into self-storage, and that would be death, divorce, downsizing, and dislocation. And that's happening a lot during crises like this. In fact, self-storage occupancy in many well-run self-storage that have, especially those where you don't actually need to meet the manager face-to-face, they're actually growing in occupancy these last few months. We don't know for sure if that'll be in the medium term, but short term, collections and occupancy in mobile home parks and self-storage has actually been on the rise a little bit. In the medium term, I don't know. I mean, look, we're looking at an unprecedented set of events. We've got a once in the last century at least, plague. You've got 10 or 12 times, from what I understand, record unemployment. 10 or 12x? What? You've got 12,000 retail establishments shutting down in 2019 in one of the best economies in history. What's going to happen now with those? Is it just going to hasten their demise? I don't know. You've got the Fed printing money at record rates. You've got record corporate and all kinds of other debt. And so we've got all these things converging all at one time. And so medium term, it's sort of everybody's guess what's going to happen. Medium to longer term, I think it's going to be a great market to buy distressed debt and distressed assets. I've had meetings 3 days in a row with investors who know how to buy distressed debt from banks, know how to buy distressed assets from banks and through other means. And so we're gearing up at Wellings Capital to put together a distressed debt or possibly a distressed debt and asset fund. And we think that will be a way where we can actually help people because, it's actually filling a niche. It's not taking advantage of people. If people lose their assets, we can step in with distressed. We can buy the debt at, let's say, 60 cents on the dollar and then go do a workout with the borrower and say, look, we're not going to come in and foreclose in 6 months when your loan's due. We're going to, extend it. We're going to work with you. We're going to try to help you get back on your feet. And if they won't or don't, we take that over and we have an asset for 50 cents on the dollar. If they do, we still make a nice profit. This is what Howard Marks, one of my investing heroes with Oak Tree Capital, has done very, very well since 1988.
When do you see that opportunity coming and about how long?
Studying every chart I can for, I have a Bigger Pocket show on Saturdays, and so I've been talking about this weekly. Every chart I have looked at has said that the very bottom in the 2000s, so I think we'd all agree that the worst of the crisis itself, the core crisis in the last time around was fall of 2008. The very bottom was hit Q1 of 2012. So I would say 3.25 years later. But prices were actually, the foreclosures actually hit their peak in 2009 and 2010, so a year later. So I think that if we follow anything similar of a pattern like that, we'll see heavy foreclosures in late 2021, and we'll see the bottom pricing by early 2023.
Interesting.
If it follows the same pattern, which there's no guarantee it will, of course.
Right.
We'll get back to our conversation with Paul in just a minute.
Have you been thinking about investing in real estate but aren't sure you have the time or the desire to manage the investment? Perhaps you're afraid, like we were, that you'll make the mistake of choosing the wrong market or the wrong team and lose your entire investment. Well, that's exactly why we created the Goodegg Investor Club. We do the work of identifying solid real estate investment opportunities in the best markets around the country and then partner with you to acquire these investments, and then we'll all share in the returns. We'll identify the growing markets, strong, experienced teams, and the solid deals. We do all the heavy lifting of managing the tenants and the renovations, and as a passive partner, you get to enjoy all the benefits of investing in real estate: monthly cash flow, long-term appreciation, and the ongoing tax benefits. When we first discovered passive investing through real estate syndications, we realized it fit perfectly into our busy lives. We could put our money to work for our families, work less, and get more time back in our days so that we could focus on what matters most and discover our true passion and purpose in life. We've now helped hundreds of people invest passively in real estate syndications and are seeing the positive impact it's had on their lives. We invite you to partner with us by joining the Goodegg Investor Club today so you can start putting your money to work for you and get more time back in your day, because we know that when people have more time in their days, they can do the true work they were intended to do, and the world will be a better place. To sign up for the Goodegg Investor Club, go to goodegginvestments.com/invest and we'll take it from there. That's goodegginvestments.com/invest.
And now, back to our chat with Paul Moore. So when you first got into real estate, you had sold your company at 33, and then around 35, you got into flipping and the auctions and that kind of thing. So what year was that?
2000.
2000. Okay. So I'm assuming that you sort of built this up. You had the shiny object syndrome. You got into a bunch of different types of assets. So tell us what happened to your portfolio in 2008. I know it's probably nothing like what's going on now, but give us some insight into what your story was and your experience was back then.
Yeah. So I'll tell you the short version. If you want to draw it out, you can. I had $1.5 million in my bank account at 34, and exactly 10 years later, in fall of 2007, I had $2.5 million in debt. And that was all against real estate properties. It wasn't a bunch of credit cards and a bunch of failed businesses or anything. It was all real estate related. And I actually, it was November 2007, and I got this idea. What would George Mueller do? Now, George Mueller is one of my heroes. He's from Germany. He lived in England, and he actually started orphanages, and he housed and cared for 10,000 orphans over his lifetime, which spanned a long time in the 1800s. And he raised what we believe to be $250 to almost $500 million in today's US dollars. And he did it all without ever asking anybody for a penny. He just had faith and he did the right thing. And so I thought, what would he do? Well, first of all, he wouldn't have any debt. He was squarely against it. So I was already in trouble on that point. But I thought he would probably do something outrageous, something completely radical, countercultural. So when my friends sat me down around that time and said, okay, you're going to have to declare bankruptcy, aren't you? And I said, no, I'm going to give my way out of debt. And that went over really well. Let me tell you.
It's the first thing that most people think of.
Oh, of course they do.
Yeah.
And so right about that time, my business partner came to me who had about a third of that debt in his name. And he said, I'm sorry, I can't do this anymore. I'm going to sign all the debt over to you. And so we're still friends today. He still works in one of my companies. But at any rate, so I was really stuck going into January 2008. And keep in mind, none of us knew how bad things were going to get. We assumed in 2007, maybe the worst was over because we can't see the future, right? And so I had no idea we were about to plunge down this black hole. But anyway, we started giving as a family every single week. And the fourth week into this, we had no idea what would happen. I met a real estate developer who gave me an idea that allowed me to have a light bulb moment this creative downloads in a Subway restaurant that would allow me to go before the Planning and Zoning Commission and subdivide a waterfront property that was not subdividable by law. And when I presented this to them, they shook their head and they were like, oh, this flies right in the face of our law. This lady said, I've been doing this job for like 30 years. No one has ever come up with such a crazy proposal. And then she laughed and said, you found a loophole in the law. Mm-hmm. And so I actually was able to subdivide that land. And in the fall of 2008, I sold 4 of the 5 lots off on that waterfront property. And within 13 months, I was 100% debt-free and even paid off my home.
Oh my gosh. Wow. That's incredible.
Wait, so, okay, hold on. So through this just sort of chance conversation, this guy told you about this loophole. So wait, what was the loophole? Why didn't anybody else know about this?
This is very technical.
Okay.
He didn't actually, I don't think he even grasped what he said. I think he basically said, use the family exemption. Since this is a real estate show, I'll try to explain it, but I'll have to hit it still high level. So he said, use the family exemption. Now, the family exemption is in many rural states, and it says, like Virginia, it says that if you have, let's say, a 40-acre farm, and you want to carve out 5 acres for aging parents, or for a child who wants to get their start and they want to build in the back of the 40 acres, that's not subdividable. You can't subdivide 5 acres in the middle of a 40-acre parcel unless you have an exemption. It's called the family exemption. Now, that means you basically donate. You carve a piece of your land off and donate it to a family member. The family member has to hold it for 5 years. And that's what I said to the guy at Subway. I said, no, if they did that, it would take 20 years to cut off 5 parcels because they have to hold it 5 before they can cut it again. And then the download I got was, wait a minute. The law, as far as I know, doesn't say anything what happens to the parent parcel, the 40 acres that cuts off 5. The 5 person has to hold it 5 years. What about the 35 that's left? It doesn't say anything. What I did is, these lots, all 5 lots were going to sell for around $300,000 each. So let's say $1.5 million total. I convinced a bank. I had $800,000 in debt on this, by the way. I convinced a bank and a buyer to buy all 5 acres for $1.5 million. And then he cut off 1 acre, the best acre, donated that to his wife. Then he immediately sold the other 4 for $1.2 million. That was the workaround. And then the next buyer bought it for $1.2, donated an acre to his wife, the one they were going to keep, and then sold the other 3 acres for $900,000. The next person did the same thing. Nobody had ever thought about the idea that you could immediately sell the parent tract, if you will. Mm-hmm, mm-hmm. That was the loophole.
Huh. That's interesting.
That's fascinating. Yeah. I love the I think when most people first think about real estate investing, they think, it's about, like spreadsheets and numbers and doing inspections and pipes and things like that. But then you get into these kinds of conversations where you really see the creativity and sort of the fun side of real estate. And I think that's the part that most people don't get to see. And it's so cool it sounds like the person who told you about that didn't even really understand it himself, but you sort of, because of your experience and your creative thinking, you were sort of able to connect the dots and thread the needle.
It's, I really do believe it was somehow mysteriously or mystically connected to the fact that we've made this commitment to give, though I can't explain it and I can't tell you that it could be replicated. I do believe in karma, or the law of sowing and reaping, as I would call it, but I don't believe there's a slot machine in the sky where you put in a quarter and you get out $1 every time. I don't believe that. Mm-hmm. So.
Yeah. I think, so much of getting these like downloads from a higher spiritual place is about living life a certain way. And I feel like that's so much of, what we do and what we strive to do and what we try to help other people do and how we try to involve so many other people in our mission for investing for good. And I just feel like so much from when we started our company and from to where we are now, we've helped so many people, and we've also received so much in return, and not just monetarily, but in so many other different ways, and in our Annie and I's relationship, and this what we do in our business. And I just feel like that's such an important reminder to people to remember that it's not always about taking and about me, but what can we do? And sometimes miracles happen, but don't do it expecting that. But I think it's such a great place to live. Yeah.
Yeah, I agree. And I can tell you, to be fully forthright, we continued to give at that level for a number of other years, and we had tremendous financial success. But then we had a couple of years where we really didn't, and we were just scraping by, and things weren't working out well. So again, I don't think it's automatic, but there you go. That's the story.
I'm curious because, everybody wants to be able to build wealth and give back. And when you get to that point, it's not always so easy to just be like, well, I'm going to give to this or I'm going to give to that. I feel like some people have that where they're really connected to a certain cause, and some people may not have that. Mm-hmm. So what was your journey like? Did you have something, a charity, an organization that you were already connected to that you wanted to commit to and give to, or were you just sort of looking around and trying out different things?
Later in the show, I'm going to tell you about what I've come to since then, and I'm very, very passionate about it now. But at that time, I just had a general sense that we wanted to help the poor. We wanted to help people in third world countries. Mm-hmm. We wanted to donate to our church. And that's where I was at that time.
It must have taken a lot of guts and courage to have, on the one hand, so much debt and sort of be almost stuck. But then on the other hand, to sort of open up your mind, your life to this whole world of giving. I feel like it's such a unique counterbalance that I think a lot of people don't really think about or don't have the courage to try in that situation.
Yeah. I mean, I honestly, if I had that much debt and that much interest payments again, I think it would be scary. I mean, it surely was then. And I for my dear wife, I can't imagine what she was thinking, so.
So I'm curious, before we switch gears a little bit, I just wanted to find out, and my guess would be that you are, but are you guys buying this year? And say for the next 12 months, what do you see for Wellings Capital on the horizon? Are you guys buying? Are you holding off to kind of see what happens? What's your approach there?
We generally, so I look at what I would do if I was a residential flipper right now. And by the way, I would be learning everything I could about subject to deals and lease option sandwiches. And I talk about these on my Saturday show on Bigger Pockets a lot. But I'd be gearing up to buy another year, maybe a year and a half from now. However, we are investing heavily with an operator who has a really unique acquisition process, and he is so good at sniffing out these off-market mom and pop deals that have amazing amount of upside potential, latent potential, if you will, that we are still investing heavily with them. In fact, we invested $6.5 million last month with them, and we plan to continue to invest heavily. The reason is he is able to, a very quick example, he called on a self-storage, I'll use a different one, a mobile home park in Louisville, and he offered him $7 million. They agreed at 7.1. The owner-operator had not visited the park in 5 years, yet it had 311 spots, so it was a large park. And so he bought it for $7.1 million, put out a press release on February 21st, and on February 27th, 6 days later, got an offer for $9.5 million. And the person making the offer, to buy this said, how did you buy this for 7.1 million? We offered them 9. And he said, well, I'm just really, he was really, really good at just, basically being very relational with the seller, knowing how to talk to a mom and pop owner, who's an older lady whose husband had left the park to her. And he said no, flatly no, because he said with 3 simple value add tweaks, we can have this park worth 12 to 14 million. Now that's 2.5x on the equity. I mean, it's, almost double the value, but 2.5x counting leverage on the equity. When you get deals like that, I feel pretty comfortable investing during this time. And we've invested in 21 deals with that operator so far this year, and most of them are pretty similar to what I just explained.
Interesting. And when you do your underwriting, how are you doing that with everything that's going on? Like, how are you adjusting your underwriting and for everything, for COVID-19, all of the uncertainty? I mean, it's an impossible task, it almost seems like. So what is your advice for people who are looking at these deals and looking at, say, your fund? How do they approach it, and how do they know it's a good bet?
Yeah, I would say, where people used to say, assume increasing occupancy, increasing rents every year, just assume at best your occupancy will be dropping a little and your rents will be dropping a little at best. And then model it and see what happens if your occupancy drops an additional 10% and your rents drop an additional 10 or 15%. And see, and then get your leverage down to where you'd still be fine if that happened. Our average leverage, loan to current value, I didn't say loan to cost, loan to current value across our portfolios probably in the 40s. So, and that's, we feel a lot more comfortable. Our debt service coverage ratio, which you're familiar with, but for listeners, that's basically the margin of safety of your net operating income compared to your debt payments. The banks want to see a 25 to 30% or higher margin of safety. Ours is 133%, meaning our debt service coverage ratio is 2.33 right now.
And can you explain to people what the difference is between the loan to cost versus loan to value and why that matters?
Yeah, sure. So if we get a mobile home park like that, where let's just say that one was acquired for cash, but then we put debt on it of 60%. So 60% of 7.1 million is roughly 4.25 million. Now, that is a loan to cost, 60%. But if we make those 3 tweaks and a year from now, the value of that park's up to 10 million, the loan to value is now only 42% rather than 60. And then if we get it to where it's worth 12 million, the loan to value might only be down in the 34% range.
Yeah, that is really low, low. I mean, when you think about the potential risk to that, I mean, it's so little because there's so much equity in there. So that's great. What is the average hold time for if someone invests in the fund, what's the average hold time for their money?
So we want to provide diversification across asset types, operators, geography, of course, the assets, but also across strategy. And across strategy means that we have some hold times, which we have some operators who want to hold forever. And we have one that has self-storage assets since 1981, literally, in Detroit. But then we have other operators like the one I'm talking most about on this show, who has an average hold time of 3.25 years. They spend the first year making the changes, fixing what's wrong, and then improving what's needed. They spend the second year increasing income and occupancy, and then third year marketing it to sell at this increased value.
Very interesting. Okay. Well, I did have one last question I want to ask you because of the name of your podcast. I think it's super interesting. And I know that, there's probably a lot of people that would love to know why you created it, but I just want to ask one question. What is the number way to lose money in real estate?
Well, we were trying to write a book called How to Lose Money, and we couldn't come up with just one.
Okay.
I think that the number one way I would say, though, of a couple would be lack of due diligence. Just, basically not following your gut, confirmation bias. You get on a track where you want to buy something. I mean, we literally, when we were trying to buy that older apartment complex, we literally started saying, well, wait a minute. New York City has 100-year-old apartments and they're fine.
Mhm.
What's wrong with a 50-year-old apartment? You know what I mean? So, yeah, confirmation bias, which is overlooking what disagrees with what you want emotionally. Yeah, lack of due diligence. It's a funny thing on our show. So it's a wealth building show where we explore why, how to lose money so you can learn not to, is the
Right.
show.
Mm-hmm.
We found one really funny thing. We had Jay Massey on, and we've learned a lot of people say, you've got to quit early. You've got to know that you're on the wrong path, pull the plug, and move on. And then we have other people who have the exact opposite experience. They would say, you never quit early. You always have to persevere. And that's how we made all this money. And so it was funny. I was like scratching my head. Now, which is it? And the answer is it's very situation dependent. And that comes with wisdom. That's why it's easier for a 50-some or 60-something-year-old to make that decision right than it is for a 20-something, because I was wrong on that piece many times in the past, and I think I would make a better decision now.
Yeah, I could not agree with you more. That's like there's like this extra intuition that you have the older you get. Every year that goes by, it adds another little drop in the bucket to that intuition bucket. I love that. All right, I am ready. Are you guys ready? Let's move into the Investing for Good impact round. So we're going to ask you a couple of questions around investing in yourself, others, and the world. So the first question is around investing in yourself. So what is one way that your investments are helping to make the world a better place?
So what's one way my investments are helping the world be a better place? So
it is allowing you to live a better life.
Allowing me to live a better life. So, when I really thought I had to do it all, when I thought I had to be an acquirer, raise capital, be an operator, asset manager, property manager, I had read Gary Keller's book, The One Thing, and realized I needed to dial in my focus on one thing. And for me, that was raising capital. And it's made my life a lot better to just be able to create content, talk to investors, and then choose great operators rather than all the other minutia of being an operator. So that's how my life's better.
Yeah, that's such a good point. I mean, that was the same for me in the very early days. I got into this business thinking I was going to do it all, me by myself. That I was going to go out there, create the broker relationships, underwrite the deals, raise the money, asset manage, and it was so daunting and so overwhelming. And here we are, and we have our niche and we have our focus, and it's allowed us to have success. So I love that. Okay, second question is around investing in others. So what is one investment strategy or hack that you might be able to share with the listeners that would help them catapult their investing journey farther faster?
Yeah, this is hard to explain, but I think there's a confusion in a lot of people's minds, confusing entrepreneurship and investing. And here's what I mean. As an entrepreneur, I want to be like Steve Jobs or Bill Gates, or I want to be somebody who creates a whole new thing and takes risks. As an investor, I found that was a good path to failure, because, there's a difference between investing and speculating. You can speculate as an entrepreneur, but as an investor, when you speculate, it means that your principal is completely at risk and you might make a return. When you invest, though, your principal is generally safe and you've got a chance to make a return. And so I would leave people with this thought that it's better over the long run to be an investor than a speculator when it comes to investing your money.
Yeah, I love that. I talk about that all the time on my calls with investors. The speculation game is no fun to play, because when you lose, you can lose big. So,
right.
Yeah, I love that. Okay. Last question, which was the one I accidentally asked in the beginning, is investing in the world. So what is one way your investments are helping to make the world a better place?
I don't know what you know about this, but about 4 years ago, I watched a movie called Nefarious. And Nefarious is put out by Exodus Cry. And the movie talks about human trafficking. Did you know that if you took the, not average, the record profits generated by Apple, Nike, Starbucks, and General Motors, took their record profits, added them together, double that number, that's the approximate revenue generated every year by human trafficking.
No.
I'd like
That's
to
insane.
believe it is. I'd like to believe that if I was alive in the 1800s, I would have been an abolitionist fighting against slavery in America or England. And if I would have been an adult in the 1960s, you might think I was, I would have been actually fighting for civil rights. Well, this is a civil right. It is slavery. And I'm trying to raise awareness for that. So we're giving a portion of our profits to fight human trafficking and rescue its victims. And we're trying to do everything we can to raise awareness of this absolute horror that's happening right under our noses.
Yeah, I don't know too much about human trafficking, but when I do hear about it, it's just it's so sad. It's terrifying. It scares me because I have 3 young children, and to think about, how these sometimes kids are going through this system. It's so terrifying to think about. Is there a specific charity or company that you work with, or?
Yeah, so I really like Exodus Cry. They're at Exodus Cry, EXODUSCRY.com. And they put out a lot of education. Their founder testified before the UN a couple of years ago. They put out films. The film Nefarious is a great starting point. I talked to their founder, and he said it was very hard to watch. He said, "Oh, that's only PG compared to the other movies I'm making
Oh my God.
that are going to be like R."
Oh my God.
And so he's got 2 other movies out since then. But yeah, I would recommend people start there. There's also, IJM, International Justice Mission, I think it is, and some other organizations. I also donate to like a farm that's sort of low key. They're not, not super public. People can ask me about it, that houses a lot of victims, but they don't want, the traffickers showing up on their doorstep, which actually happened once.
Oh my gosh, that's crazy.
Wow. I can't even begin to wrap my mind around that. I saw a documentary. I think it was with the founder of Operation Underground Railroad, and he was talking about how, when he talks about human trafficking, people turn away. It's so ugly and it's so hard to deal with. That's part of the reason why it's been able to go on so long and grow as big as it has, is because people it's too hard for people to grapple with. And so it's amazing what you're doing and how you're giving back through all that you've built and all that you're doing. So we applaud you for that, and we hope to join you in that journey. Well, Paul, thank you so much for your time. Tell us how our listeners can, I know you're all over the place. You're on Bigger Pockets. You've got your podcast. What's the best place for people to go to connect with you, possibly learn more about Wellings Capital and all that you're doing?
Yeah, so we have a new podcast called The Art of Investing. It's not out yet, but we'd love to have you as guests. But the best way to reach me is at my website, wellingscapital.com. That's WELLINGS capital.com.
Great. Well, we will have that in the show notes, along with the link to Exodus Cry as well. Paul Moore, managing partner at Wellings Capital and co-host of the podcast How to Lose Money and the new podcast, The Art of Investing. Thank you so much for being here with us, Paul.
Thank you. It was an honor.
You've been listening to Investing for Good, the #1 podcast for people like you who are investing to build a legacy for their families, create a meaningful and intentional life by design, and impact the world around them. For more resources, check out goodegginvestments.com/podcast. And be sure to join the Investing for Good Facebook community. And don't forget to subscribe and give us a 5-star review so we can continue to bring you amazing new conversations every week. Until next time, keep investing for good.